What's up everyone? This is my opening trade alert for RCL, or Royal Caribbean Group. They are the cruise ships if you don't know. This trade is pretty much my bread and butter. RCL technically had a little down day here and I sold a put. So I sold the 60 put in the March expiration and I collected $1.80. Over here at the trade tab, I'm in the 30 to 60 day window, which means March 19th. So 37 days is within the 30 to 60 day window. Then my normal entry guidelines, which is what I followed this time, is somewhere in the 15 delta or 20 delta range. So typically I try to collect $1.50 to $2 kind of as a minimum. However, that really depends on the ticker and the value of the stock. You know, this one's more of a medium value, where if it was a low value, you know, I could be okay just collecting like $100 or $1. These medium level ones, you know, it's more like $2, give or take, $1.50-ish. And then you get up to the higher dollar tickers. I mean, that can be $400 or $500 when you're out at like the 15 or 20 delta. So anyways, my normal guidelines are 15 to 20 delta, somewhere around $1.50 and $2. This one pretty much fits right in. I sold the 60 strike here. I only collected about $1.80. Looks like right now you can collect $2.11. That leaves me with a 75% pop, 86% P50. My max profit is $211 because I collect $2.11 per contract, right? So if you got 2 contracts, that'd go up to $422 and so on. And my max loss, if this stock decided to go to zero, would be $5,789. And then this is why I trade RCL quite a bit, is because the buying power effect is pretty stinking low. You just get a bigger bang for your buck, right? And that's kind of what trading's all about, is the return on capital, not necessarily the dollar amount. Anyways, staying on track, that's a different video probably. I like this because it's lower buying power. You know, I can collect around $2 and it only takes $600 per contract. So quick math there, if you collect $200 or $2, and then you divide that by 600, that's 33%. But then if you take 50% of that, divide that by 2, so you'd keep $100 out of the 200 that you collected, that's a 16% return on capital. And that's great. Anything above like 10 or 12% is starting to get really good. And some of these tickers, the return on capital at 50% is like 20, 25%. It's crazy. All right, let's take a look at the chart. As you can see, I opened the trade here today, the 10th of February. I sold the 60 put for $1.80, which is right here. So all I want this to do is to stay above the $60 strike, right? So as long as it stays above here, I will eventually get paid. And the great thing with going to the 15 or 20 delta, or sometimes you can go farther depending on the ticker, going farther out of the money like that, you still collect a decent premium, right? Like $1.80 to $2. But then this could even go against me from $70 down here to, you know, like 62 or something, right? Or 65. And yeah, I'll be in the trade longer, but I will still get paid even though I was wrong on the direction, right? The current price is like 68 bucks, or I think it was around 70 when I opened. So even if I'm wrong, eventually time decay kicks in and I get paid as long as it stays above 60 here. So that's awesome. And that's why I love selling puts. Basically, I just waited. There was a big run up here. I waited for the sell-off. They had earnings just like yesterday or today or something. The MACD is looking pretty good. It's in the negative territory and it crossed up into the green. It's kind of weak, but it's still crossing up green. RSI is neutral to favorable. And then you can see here, there's a long-term channel going up from the COVID crash, and it's bouncing right at that channel. And then also here in the Elliott wave, this is the larger intermediate. You're in the 1, 2, and this is like in the middle of the 3rd wave up. And it makes sense that it could come up here because this is the pre-COVID high over here, right? And then within this intermediate wave is the minor wave that goes like that, right? So within this 2 to 3 wave on the intermediate, the yellow line, you're gonna have a smaller fractal wave, right? Which is 5 waves. So you have 1, 2, 3, 4, 5 within that larger wave. So that's what the green line is here. So now this is 1 up, 2 down, and we're like halfway to 3 here. And within this 2 to 3 wave, there's another like 1, 2 down, right? And now we're heading up 3, and then at 3 will probably peak around here, push back 4, and then 5 will end at that 3 point. So anyways, hopefully that's not too confusing, but long story short, the Elliott waves, in my opinion, stack up here nicely to getting in here. Got in after earnings, It's hitting this long-term channel. In my opinion, it's just gonna head higher from here. It might trickle to the side a little bit here and actually follow this channel, but that's fine. Again, as long as it stays above 60, I'm good to go. All right, I think that covers everything. Selling puts like this is pretty much my bread and butter. Like I said, just look for these run-ups and then for the bigger sell-offs. And then when it looks like it's gonna turn around here, just sell a put that's farther out of the money. And the farther out of the money you go, the more breathing room you have, right? If you sold a 50 put, it'd have to drop $20 after already dropping, $15. So I guess the last thing is here, I take profits right around 50%. Depending on how aggressive you want to be, you can take profits anywhere from 30% to like 70% for a naked put. So the happy medium there is obviously somewhere around 50%. But again, anywhere over 30% and you can justify taking profits. So it's whatever your comfort level with risk is. I think that's it for now. Thanks for tuning in, and I'll see you in the next video.